Usually when you look at a stock chart and see a massive, like 62% drop from its highs, it means something is just fundamentally broken.
Oh, absolutely.
Because, the market is pretty ruthlessly efficient about that kind of thing. A drop of that magnitude usually tells you a company has lost its edge, or a core product failed, or the revenue just completely dried up.
Yeah, it's basically the market pricing in a total disaster. It is visible, it's brutal, and it almost always follows a really clear, logical failure in the underlying business.
Right, but then you look at Oracle, and suddenly the dashboard is flashing these completely contradictory signals.
It's wild.
So, welcome to this deep dive, where today we are unpacking what has to be one of the most polarizing and honestly fascinating company pivots in the market right now.
It really is a massive tug of war.
Yeah, and we are pulling from a huge stack of recent Wall Street analyst notes, S&P global credit reports, and Oracle's own latest 10K filings to figure out this paradox. Our mission for you listening is to understand how a foundational tech giant has engineered a massive 93% growth in its cloud infrastructure.
Which is huge.
Right, and amassed a staggering $638 billion revenue backlog, yet somehow finds its stock trading down 62% from its 52-week high.
And, with a credit rating teetering right on the edge of junk status,
Exactly.
you basically have operational success that looks like a rocket ship, but it's shackled to a balance sheet that looks like an absolute anchor.
Yeah.
So we are going to synthesize the recent financial data and these strategic partnership announcements to help you map out this high-stakes financial thriller playing out in real time.
I am honestly looking at this as the ultimate contrarian AI trade. I mean, the immediate glaring paradox is sitting right there in the stock price.
Right.
It is currently hovering around $129.87. That represents a 33% drop year to date, while the broader S&P 500 is actually up nearly 9% over the same period.
Yeah, it's massively underperforming the broader market.
But then if you dive into the Wall Street analyst notes in our sources, they have a consensus price target of over $248.
And some desks are even aggressively targeting $400.
Which is insane. For you listening, that implies an upside of anywhere from 95% to over 200%.
Right.
So let's look at the raw operational data that has these analysts so incredibly bullish. We are looking at Oracle Cloud Infrastructure, or OCI, and it grew a massive 93% year over year to $5.79 billion in Q4 of fiscal year 2026.
And that growth actually accelerated every single quarter of the fiscal year.
Wow.
Overall, total trailing 12-month revenue growth is sitting at 17.35%. But what really stands out in the filings is the underlying profitability here.
Right, the margins.
Yeah, they are posting gross margins nearing 66% and net margins over 25%. The mechanics of hitting a 66% gross margin while scaling cloud infrastructure are incredibly difficult.
Because usually building data centers just destroys margins for years,
Yeah,
right?
exactly. Oracle is achieving this because they are largely upselling into their massive pre-existing base of enterprise software customers.
Yeah.
So the customer acquisition cost is remarkably low.
Which leads perfectly into the crown jewel metric here, which is remaining performance obligations, or RPO.
Yes.
Oracle's RPO just hit $638 billion.
Which is just staggering.
It really is. That is up 363% year over year. So to break down RPO for you listening, it isn't cash in hand today. Is it sort of like a massively overbooked exclusive restaurant?
Yeah, that's a great way to think about it.
Like where VIPs have already prepaid for their meals for the next 5 years, so the revenue is practically guaranteed. The restaurant still has to actually cook the meals, but the income is locked in by a binding contract.
I agree completely with that analogy. And the timeline on those contracts is really the key to this entire valuation puzzle.
How so?
Well, Oracle's management projects that 12% of this $638 billion backlog will convert to actual recognized revenue in the next 12 months.
Okay, so wait. That means we are talking about over $76 billion guaranteed for the next year alone.
Exactly.
And their entire target revenue for fiscal 2027 is $90 billion. So this converting backlog alone covers 85% of their revenue target for the year before they even sign a single new customer.
Right. It provides a level of visibility that most companies can only dream of. But there's also a fascinating structural detail hidden in that massive RPO number.
What is it?
$75 billion of that backlog is specifically tied to prepaid or customer-supplied compute arrangements.
Wait, really? The customers are supplying their own compute?
Yeah, they are.
That completely shifts the capital expenditure burden off Oracle's shoulders.
Yeah, it does. By having $75 billion of their contracts structured, so that the customers are either prepaying for the compute infrastructure or literally supplying the GPUs and chips themselves. Oracle dramatically eases its own CapEx burden.
That is so smart.
Right. They're essentially just renting out the sophisticated data center space, the power, and the cooling without having to take on the depreciation risk of the hardware itself.
That is a massive strategic advantage. But, it brings up a really critical question regarding market dynamics.
Sure.
If you are a massive corporation that needs enterprise AI infrastructure, why are you signing these huge contracts with Oracle? I mean, Microsoft Azure, Amazon Web Services, and Google Cloud are the behemoths in the room.
Yeah, they absolutely dominate the space.
Right, so winning these contracts against them seems almost impossible on paper.
Well, they are managing it through what might be their most unconventional competitive strategy to date. You can view it as a multi-layered switching cost strategy.
Okay, how does that work?
Instead of fighting Microsoft, Google, and Amazon head-on in this brutal war for every single cloud footprint, Oracle is embedding its OCI infrastructure directly inside Azure, Google Cloud, and AWS data centers.
I have to challenge the logic there, honestly.
Go for it.
The entire playbook of big tech over the last 2 decades has been to build a walled garden. You trap the user in your ecosystem.
Right.
So why is Oracle actively moving its infrastructure into the data centers of its biggest rivals? And perhaps more importantly, why on earth are Microsoft and Google letting them through the front door?
Let's look at the mechanism there because it specifically solves the issue of latency and data gravity.
Okay.
Enterprise customers often have their massive legacy databases running on Oracle, right? But they want to use Microsoft Azure's compute tools to analyze that data.
Sure.
If those two systems are in different physical data centers in different states, the latency, the time it takes for the data to travel back and forth makes high-speed AI applications completely impossible.
Oh, I see.
So by physically co-locating Oracle servers inside Azure data centers, the latency drops to near zero.
So Microsoft allows this because it keeps the customer on Azure's broader ecosystem rather than losing them entirely to Oracle. It is sort of a localized compromise for mutual retention.
You hit the nail on the head. Oracle recognized a fundamental truth about enterprise AI.
Which is?
The biggest hurdle isn't getting access to the AI models. The real deployment gap is the friction of moving those models into daily business production. If you force a company to migrate its entire database to a new cloud just to use a new AI model, they will simply stall the project. So Oracle positioned itself as the Switzerland of enterprise AI.
The Switzerland of AI, I like that.
Yeah, and look at their newly expanded Alphabet partnership in the research notes. They're integrating Google's Gemini AI models, including Gemini 2.5 Flash and Pro, directly across Oracle's Fusion applications and NetSuite.
Which are the core software platforms companies already use to run their businesses.
Exactly.
Let's think about a real-world application of that for a second. If you are a supply chain manager using NetSuite, you don't need to hire a team of developers to build a custom AI tool.
No, not at all.
You can just use the Gemini integration directly inside your existing dashboard to instantly analyze thousands of supplier contracts or, predict inventory shortages based on real-time weather data.
And that frictionless deployment is where the real money is. Oracle now offers a lineup of models. They have Meta's Llama, OpenAI, Cohere, xAI's Grok, and now Google Gemini.
Wow, so they really are agnostic.
Yeah, they basically sell the room where everybody's models can be used. They capture the enterprise AI spend at the application layer without forcing the customer to fight an infrastructure war.
Okay, so if they have a $638 billion backlog and a genius Switzerland strategy, the market should be rewarding them.
Right, you would think so.
But it's punishing them. So the missing piece of this puzzle has to be how they are actually paying for all this infrastructure, because you don't drop 62% from your highs just on good news.
No, you definitely do. And this is where we pivot to the bear case, because the balance sheet is the sole reason for the massive multi-week drawdowns we've seen.
Let's hear the damage.
The numbers here are terrifying for a traditional value investor. We have to look at the cash burn. In fiscal 2026, Oracle's free cash flow was negative $23.7 billion.
Negative $23 billion. Wow.
Yeah, and that was driven by an unprecedented $55.7 billion in capital expenditures just to build out these AI data centers, secure the land, and sign the long-term power contracts.
And according to the S&P Global reports, it is not stopping anytime soon.
Not at all.
They are projecting a $42 billion free cash flow deficit for fiscal 2027, a $42 billion deficit.
It's a massive hole.
Because of that burn rate, S&P Global cut Oracle's credit rating to BBB-. And for you listening, BBB- is exactly one single notch above junk status.
Just one notch.
Their total liabilities are now sitting at a staggering $218.7 billion.
The leverage is just immense. And, there's a profound human cost to this pivot as well.
Right.
To help fund this infrastructure build-out, Oracle laid off approximately 21,000 employees. That was roughly 13% of its entire workforce.
But wait, firing 13% of your workforce when revenue is allegedly guaranteed? That just doesn't add up.
It raises some eyebrows for sure.
Are they just aggressively trimming legacy fat, or are they desperately freeing up cash just to keep the lights on for these new AI data centers?
Well, the analyst notes suggest it is heavily skewed toward the latter. A massive portion of their capital is being diverted toward a $300 billion AI computing contract with OpenAI, alongside a broader $260 billion AI leasing plan.
This honestly sounds like taking out a second, third, and fourth mortgage to build the world's biggest casino just because a few high rollers promised they'd show up.
That's a very fair comparison.
What happens if a massive anchor client like OpenAI decides they don't need as much capacity, or they find a cheaper casino down the road?
That is the exact fear. S&P Global Ratings specifically identified that exact scenario as a massive risk. It's huge customer concentration. OpenAI makes up a huge portion of that $638 billion backlog. The structural problem Oracle faces is one of timing and sequence. The debt for the data centers, the cooling systems, and those 20-year power contracts, all of that lands squarely on Oracle's balance sheet today.
Well, the revenue is just a promise for tomorrow.
Exactly. If OpenAI, or really any other anchor customer, renegotiates, delays their deployment, or just outright defaults, that RPO backlog evaporates.
But the debt stays.
The debt stays. The liability is locked in. If that free cash flow stays deeply negative and their credit rating slips that final notch into junk territory, Oracle's cost of capital will spike.
Oh, man.
Yeah, refinancing a portion of $218 billion in liabilities at junk bond interest rates could trigger a catastrophic financial spiral.
So we have outlined the fundamental tug of war for the listener here. You've got the seemingly guaranteed revenue backlog versus the terrifying, highly leveraged balance sheet.
Yep, that's the setup.
The final piece of the puzzle is market sentiment. How do we actually navigate the setup, and what are the catalysts that will determine which side wins?
Well, we have to start with the current valuation. Because of this massive sell-off, Oracle is trading at a forward price-to-earnings ratio of just 15.
And for context, that is incredibly cheap for a tech giant sitting at the dead center of the AI boom.
It really is.
The broader S&P 500 average is much higher, and typical high-growth tech stocks often trade at forward PEs of 30, 40, or even way beyond that.
So the stock is currently priced for catastrophe. But we are starting to see minor shifts in that narrative.
Like what?
Well, the stock recently bounced 8.32% off its capitulation lows. A significant portion of that was triggered by the announcement of the Google-Gemini partnership, which actually spiked the stock over 6% intraday.
Wow.
The market recognized that embedding Google's AI into Oracle software was a massive strategic victory.
The sources also point to some really interesting signals coming from inside the house. We looked at the insider trading data, specifically the management sentiment and performance ratio, or MSPR.
Right.
Right now, Oracle's MSPR is a perfect 100.
We should probably explain the mechanics of that score, because at first glance, the raw transaction data looks negative.
Yeah, it does.
Over the last 90 days, insiders have sold more individual blocks of shares than they have bought. There were 20 sell transactions compared to 18 buys, which results in a net negative share count.
So why is the sentiment score a perfect 100 if the transaction count leans towards selling?
It all comes down to the weight and conviction of the capital being deployed. The insiders who are buying are deploying disproportionately massive dollar amounts at these depressed stock levels compared to their historical patterns.
Oh, I get it.
Yeah, the sell transactions are mostly just routine tax selling or scheduled diversification plans. But the conviction of the buyers, however, is off the charts. They are backing up the truck and aggressively acquiring shares at $130.
So think about this asymmetric setup for a second. You have 37 out of 43 Wall Street analysts screaming buy or strong buy.
Yeah.
You have company insiders throwing massive weight into buying shares at the bottom. But the broader market has been aggressively selling it off all year, driving it down 62%. Who is right?
Well, the people screaming buy are not ignoring the $218 billion in debt. The balance sheet risks are entirely known, public information.
Right, everyone can see it.
Exactly. The market has heavily priced those fears into that 62% drop. The path to that $248 consensus target isn't a question of whether the demand for enterprise AI exists. The $638 billion backlog proves the demand is there.
So the real question is purely one of execution timing.
Exactly.
Can management convert that backlog into actual recognized cash flow fast enough to satisfy the credit rating agencies and avoid junk status?
It is a race against the clock. And looking at the catalyst calendar for the next few months, there are two major checkpoints in this race.
Okay, what's the first one?
First, we have the Q1 fiscal 2027 earnings coming up in September. Management has guided for cloud revenue growth between 58 and 64%.
Okay.
If they hit or beat that target and demonstrate clear acceleration in converting that backlog to cash, you could see a massive re-rating of the stock.
And the second major catalyst?
It isn't even in Oracle's control. It's the Federal Reserve.
Rate cuts.
Exactly.
Because a company carrying $218 billion in liabilities is incredibly sensitive to the macro interest rate environment.
Spot on. If the Fed begins a cycle of rate cuts between September and December, Oracle's cost of capital goes down. The pressure on their balance sheet eases significantly.
Right.
Refinancing debt becomes cheaper, which buys them the crucial time they need for that backlog to convert into cash. It would be a massive macroeconomic tailwind that could lift them away from that junk bond threshold.
Let's bring this all together. The duality of Oracle right now is just staggering. On one hand, it is the fastest growing major cloud infrastructure player in the world. It is armed with this brilliant multi-model Switzerland of AI strategy that embeds its services seamlessly into its competitors' ecosystems, and it is sitting on a backlog of revenue that practically guarantees years of top-line growth.
It sounds perfect.
Right. But on the exact same day, it is a highly leveraged, extremely rate-sensitive company that just fired 13% of its workforce and is fighting tooth and nail to keep its massive debt out of junk bond territory.
It is the ultimate high-wire act in the tech sector today.
It really is, and it leaves you with a broader thought to mull over. We've seen Oracle risk its entire financial stability just to build the infrastructure for AI.
Yeah.
If a legacy giant like Oracle, with decades of foundational enterprise relationships and massive free cash flow from its legacy software business, has to risk junk bond status and take on hundreds of billions in debt just to afford a seat at the AI table, what does that mean for the rest of the industry?
That is the billion-dollar question.
If the table stakes to compete in the future of enterprise AI require risking total financial ruin, are we entering an era where only the most financially reckless or maybe visionary companies will survive? What does this mean for the stability of the tech sector as a whole?
It really makes you wonder if the era of this crappy tech underdog is just completely over.
It really does. Well, thank you for joining us on this deep dive into Oracle's high-stakes pivot. Keep questioning the numbers behind the narratives, keep looking for the friction points in these massive tech transitions, and we will catch you next time. Remember, the market is efficient until suddenly the debt gets too heavy and things get very, very murky.